Welcome, market participants, to another Three Things in Credit. I'm Van Hester, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So, it's SpaceX week, and that means lots of talk of crowding out. I get the angst and wonder. $200 billion or so in the three big IPOs, plus big secondary offerings from hyperscalers into an equity market that has shrunk for 23 years, according to the FT. And more, no doubt, coming in 2027. Add to the equity capital raises $150 billion a year or so for the next several years of hyperscaler public debt. And then there's AI-related private debt, project finance debt, CMBS, and ABS. It's a big load. But I'm not convinced this will add up to anything more than maybe a bit of indigestion. The AI stories, debt and equity, remain attractive, a rare mix of hope and formidable and solid cash flows. Tapping both debt and equity markets are supportive to each respective market. Bondholders cheer, they're also issuing equity. Shareholders cheer, they're also issuing debt. These stories are globally understood, which will draw in lots of interest from overseas markets that, frankly, just don't have these opportunities at home. What gets crowded out are weaker stories. Supply creates demand. Let the rivers flow. All right, this week our three things are: 1. Deflation. It's a check on the market's most significant near-term risk. 2. Credit loss cycle. Is it upon us? And 3. CCC signal. What the weakest credits are suggesting. All right, let's dig a bit deeper. Deflation. Now, by many, if not most accounts, inflation is the single greatest near-term risk to credit markets. Although there are stark differences between today and 2022, more than a few bond investors carry lingering baggage around what was the worst bond market in the 50-year life of the Bloomberg aggregate. So it's a worthwhile endeavor to remind us of what the predominant force impacting prices was for the decade before COVID. It was deflation. Yes, deflation. Globalization and technological advancement in all of its forms, automation, digitization, along with post-GFC economic scarring, deteriorating demographics, and cheap energy, worked to offset significantly any inflationary price pressures from 2010 to 2020. Central banks spent much of that time trying to stoke inflation by cutting rates to zero and launching massive quantitative easing programs. Then COVID happened, triggering massive monetary and fiscal relief, both of which worked to drive inflation to its highest level in 40 years. Today, we bemoan the fact that inflation has run above target for 5 years and that the Fed is on hold, forgetting that rates have been cut 175 basis points from the recent peak. Now, looking ahead, how do we view those two forces of deflation, globalization and technological advancement? Well, globalization has turned to deglobalization as countries move to secure strategically important goods and supply chains, and that is inflationary. But net-net, we still see globalization being deflationary as many more goods fall into the non-strategically critical bucket. China and its manufacturing prowess remains a powerful deflationary force. Meanwhile, on the tech front, AI should prove to be deflationary over the intermediate term, although the current arms race underway to build AI infrastructure is clearly inflationary due to the demand shock in markets providing chips, construction, power, and the like related to the build-out. We would remind you that the series of supply shocks that have kept inflation above target over the past 5 years, namely COVID, Russia-Ukraine, tariffs, and Iran, is not likely to extend, or at least it's not something that we can model out with any degree of certainty today. Still, the lingering effects of these mean that rates are still more restrictive today than otherwise would be the case. Look no further than the housing market, as well as wage growth coming down as evidence. So, absent additional supply shocks, and as long as inflation expectations remain relatively well anchored, we could still see additional rate relief in the back half of 2026. Granted, by our calculation, that looks like no more than one cut. So, while we are in the inflation is the most significant near-term risk camp, we do believe a more complete read, including an accounting of deflationary forces, keeps it all in proper perspective. All right, on to our second thing, credit loss cycle. After years of effortless returns, the default cycle is reasserting itself, and we expect significantly higher losses in lower quality credit, such as leveraged and private direct lending. So says asset manager PIMCO this week in a piece entitled Rupture and Resilience. While they do not specify what significantly higher means in terms of losses, we can assume at least above average, call it 3.5% for high yield bonds and 3% for leveraged loans. So let's dig into this a bit. According to the piece, years of abundant capital and buy the dip behavior have encouraged aggressive underwriting, high leverage, and widespread use of floating rate structures. On top of this, the asset manager sees the incursion of AI and the rise in geopolitical risk as additional risk factors driving losses higher. Conceptually, we don't disagree with much of this, but the degree to which these factors present risk is debatable in our opinion, and we believe the call underweights the resilience part of its story. Aggressive underwriting? Well, we would agree if for no other reason than a not insignificant portion of what is on the books today was underwritten in an environment, 2020 to 2022, that featured ultra-low rates and no prospects for AI disruption. So yes, losses of those vintages continue to bleed out, but not at alarming levels. High leverage? Well, that's tougher to see. Overall, in high yield, net debt to EBITDA Q1 2021 was 3.8 times. Today, it's 3.8 times. Interest coverage then was 2.9 times. Today, it's 2.7 times. What about in riskier segments, you ask? Well, single Bs then saw leverage at 4.3 times. Today, it's 4.4 times. Interest coverage then was 2.3 times. Today, it's 2 times. So on the margin, a touch weaker among weaker credits. Enough to drive losses significantly higher? Well, we'll take the under. Our rationale believes companies have adjusted their businesses to the more challenging risk environment. We talk often of constructive pessimism, where limited visibility and a series of rolling industry-specific recessions, such as energy in 2014 and 15 or retailing in 2018, well, that's kept financial, strategic, and operational risk under control. We also recognize that higher, i.e. normal, cost of capital became a thing in 2023 as rates spiked higher. Companies have adjusted. And finally, there is the growth environment. It's constructive and not just tech. And it figures to stay that way, 2+% growth in real GDP through 2028, if we believe the Bloomberg consensus. Yes, there are tail risks, especially on the geopolitical front, that are not insignificant. But we see the resilient part of the story to be, well, resilient. All right, on to our third thing, CCC signal. Now, notwithstanding our comments above that the bonds are all right, where we are in agreement with PIMCO is that the credit environment is getting more challenging than has been the case, and accordingly, the weakest credits will be facing a more testing backdrop. So we expect the higher quality splits, say between public investment grade and public high yield, where the quality mix, of course, has moved up substantially over the years. While we think that's going to continue to remain relatively flat at historically tight levels. But out the credit curve, we're seeing a different story. And it's noteworthy that the differential between somewhat risky credit and super risky credit, that's CCCs less BBBs, has risen sharply of late. Now, this is perfectly consistent with our forward look where we expect economic headwinds to rise as the consumer is less willing and able on the margin to spend while businesses face higher costs and technological disruption. And then there's the uncertainty surrounding the geopolitical environment. Now, taking all of that into consideration, we're anticipating the vast majority of firms will be able to ride this out with minimal and manageable impact. The most vulnerable firms, however, those with deficient business models and/or strategy execution, along with an inappropriate capital structures, well, they figure to struggle. And that is showing up in the underperformance of CCC credit spreads. So reiterating our comments earlier, we are not expecting a significant rise in leveraged finance default rates, although we are on the lookout for more severe loss given default in this cycle. But this move out in CCC spreads is consistent with rising economic headwinds and growing investor concern on the riskiest credits. So there you have it. 3 things in credit. 1, deflation. It will help keep inflation in check. 2, credit loss cycle. We are not seeing significantly higher loss rates over the near term. And 3, CCC signal. Investors are seeing heightened vulnerability in the weakest credits. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.